Robschild. No investment advice. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Wednesday, October 9th, 2024. Today's episode, I'm going to start with a quote, an important quote that is an important reminder to always have in the back of your head. And the quote is, "Markets can remain irrational longer than you can remain solvent." Famously said by John Maynard Keynes a long time ago. You've probably heard this quote before if you're watching this video. The point of me bringing it up right now is that, as you know, I am very bearish the S&P 500. I'm very bearish junk bonds right now. But betting against those, it's like, is it going to play out within the next few days? Is it going to play out within a week, a month, a year, 2 years? I'm very, very confident it will play out, but this truth remains that markets really can and will often remain irrational longer than people can remain solvent. Just because you have all of the data in the world, Mr. Market doesn't care. Mr. Market, just think about, for a second, like all of the people out there that control their own assets, and, let's say they even have a financial manager. Let's say you have this like billionaire that inherited billions of dollars and they have a financial advisor. Well, the person is still able to tell their financial advisor, hey, gold's going up, I want to buy a bunch of gold. Markets, I underestimate all the time how irrational markets can be. It's not a machine. This is not an AI driven machine that accurately weighs the valuations between things very well. It does the absolute opposite. And so there's ways of taking advantage of that, obviously, when you look into things. But at the same time, you need to realize that Mr. Market is often extremely irrational and can remain irrational longer than you can remain solvent if you're putting, for example, everything you own on a bet that something's going to crash. Even Michael Burry was something like 2 years early on the housing market bubble popping. And part of it was things happening that were unexpected that actually helped keep it afloat for longer, that were constantly surprising him. But eventually it did play out because like Benjamin Graham apparently said, besides his quote that says stocks are a voting machine, not a weighing machine, but really they're eventually a weighting machine. And, more specifically, now that I think about it, in his main work, the security analysis, he goes into a little bit more depth on this. And the important takeaway from it that I remember was that markets can remain irrational for so long that eventually you can actually have what you're trying to accomplish not play out because it's already passed. And that, for example, right now, against my bearishness, could be the soft landing. It's not out of the realm of possibilities. I think it's unbelievably unlikely. But I just wanted to stress the point that main point here is that even if you're right, you can be wrong, because at the end of the day, it's people voting how much things are worth, and as long as those votes stay, they can keep going against you. Now, with all of that said, that's one of the reasons why I really like the short junk bond position, is because Mr. Market doesn't control those as much. See, the way it works is when default rates go up and these bonds are unable to pay their obligations, or some of them become worth nothing, it's an automatic process. The bond market is more of a weighing machine, much more so than the stock market. And so that's why I prefer, if I'm going to be, speculating with a certain portion of my portfolio to go against the overvaluations of the markets, I think the safer and more, the safer way of winning on that trade is going bearish junk bonds. So yeah, through my more recent continuing to buy puts on HYG, I'm now actually, I said I'd never go above 2% allocation. It's just too tasty to me. I can't, I'm not going to go full 50%. I'm not going to do something that's going to blow up my account, but I did raise to 3% recently, and that's put contracts on HYG. Next thing on today's episode, the VIX is still in fear, and the S&P 500 is still in greed. So that's the same thing I said yesterday, but with one little update. So first of all, CNN almost in extreme greed mode, according to this metric, and the S&P 500 at all-time highs, closing all-time highs today. My best guess at this point, since we consolidated and are clearly breaking higher here, there's a million different trend lines you can draw and Fibonacci retraces and all that stuff. But my guess, 6,000 is where we're headed now, and it will be a blow off top, and that's when the crash will begin. I see it in the crystal ball. I'm taking CNN reading of greed and the bullish looking chart in the S&P 500 with a huge grain of salt for 1.5 million reasons, but one of them includes the fact that the dollar index has been actually going up. Usually this goes down as the S&P 500 goes up. As strange divergences appear, reversion is near. Also, the VIX. This is clearly still closed above 20. 20 is kind of a magic number, as in like we're pricing in some volatility coming up at all-time highs in the S&P 500, at an S&P 500 PE ratio of 30, at the time when the cuts start, at the time when the Fed was clearly fearful, at the time where we are expecting more cuts, at the time where the Fed is still strangling the economy, at the time where Fed Powell says, hey, we're worried about the labor market falling apart, while continuing to choke the economy. But what do I know? I'm just a guy with a crystal ball. Main thing on today's episode, we have CPI coming out tomorrow, PPI coming out on Friday. Also, notably, JP Morgan earnings come out on Friday. It's not just the earnings, it's the data that comes along with it from their CEO, Jamie Dimon, and all of the reports going along with it. They give a sense of credit, like how risky is credit, or people paying off their bills, or how do the banks feel about lending right now, all of these kinds of things. So that information that really could rock things on Friday specifically, but we'll see. If you want details on my daily reminders, watch Monday's show. The crystal, nothing's changed today on any of this. I do want to bring up the 2-year, 10-year Treasury yield curve today, but for now, the crystal ball reading still says bear market soon, and I am of the belief that the Fed won't cut fast enough to save the economy. I think we're in for a doozy of a recession or a depression. One of the major items on my daily reminders is the 10-year, 2-year, or 2-year, 10-year yield curve. So when things are normal, people can lend their money to the government for a piece of paper that gives them a certain amount of money back over the next 2 years. Same with same with 10 years. Now, if you let them borrow it for 10 years, you're going to say, oh, you got to pay me more every year because I'm lending it to you for a longer time. And I don't know what's going to happen with interest rates or anything really. It's a higher risk and it's longer time. You got to pay for the time. It's time premium. But when it's inverted, that's when the Federal Reserve, our central bank, breaks the system and offers a risk-free rate overnight higher than the rest of the maturities. So you can lend your money overnight, basically keeping your money in a money market account, and you're going to get a higher yield than what you would get for lending your money to the government for, say, a 30-year bond. And so when it's inverted, it's very strange. And typically when it reverts and goes back to normal, that's been the beginning of every recession over many decades now. This is the 10-year minus 2-year bond yield. 0 means that they're yielding the same. When it's negative, it means that the 2-year yields more than the 10-year. When it's above the black line, it means that the 10-year is yielding more than the 2-year. The last time we had it below 0 for this long was basically right before the Great Depression. And as part of my daily reminders, that would suggest that, hey, maybe we're headed into a major depression. And the worst of it usually starts when we go above the black line, which we just did. We just got above the black line. Now, the main reason I want to bring up this today is because we have been going straight back down to 0 recently. And so if we do go back below the black line, that can suggest that the risk on environment may last much longer than we expect. And if we have it inverted for even longer, I would expect for the recession or coming recession, depression, the slow part of the cycle, the business cycle. There's always a business cycle. There's ups and there's downs. When the down comes, if this becomes prolonged, I think it will be even worse than it would be if this doesn't stay uninverted or reverted. So looking back at this chart here, if we just scroll out, this current view goes back to 1977. You can see here, for example, in 2006, this is a small example, but we had this uninversion. We had an inversion in 2006 and then an uninversion, and then normally we might say, okay, May of 2006 recession is imminent, but the recession didn't actually start it was a year and a half later, because what we did was we reinverted and then we uninverted and then we really uninverted, and that's when the great financial crisis had occurred. And another example of this was in 1989. Let's see if we can scroll into that little area here. So we inverted and then we uninverted, but then we reinverted, and then we dipped into it one more time before the recession started. So if you took this first uninversion, June 89, we didn't really make it till May of 1990, so about a year later after that first uninversion. Now, granted, both of these periods of inversion were very, very short before they uninverted. The 2000 dot-com bubble bursting, there was no up and down. It just went straight into recession. But the point is that you do have to keep a pretty close eye on this. It will be insane, I think, if this inverts again. But it's not out of the realm of possibilities, and we have to take that into account. This recession or depression may be further out than we might think. It's not possible to give an exact date unless you have a crystal ball. And it's probably about time I come clean about my crystal ball. It's not even real crystal. It's made of glass. Sorry, guys. I am essentially 3% in put contracts on HYG. So, as you might believe, I am very bearish junk bonds right now. From a daily pattern chart, it's still bearish. We have an inside day. This red candle still dominates the narrative here, and it wants to go down more than it wants to go up, that's for sure. Last chart of the day, this one was fascinating. I redrew my trend line on the 30-year Treasury bond. Now, what I did was I took the exact point on, it was December 27th of 2023, and I lined it up with the exact top peak of yields back in 2021. This is March 19th, I think, of 2021. When you connect those two together, that's when you get this head and shoulders pattern that I've been talking about. This is why I'm like 50%, and this is partly why, one of many reasons why I'm currently 50% in TLT. We have a shoulder, a head, and a shoulder, a break, and we actually, by that way of writing the line, we kissed that line to like the penny today. Amazing stuff. So I'm thinking, based on this very long trend line, that this might be a bottom in the value of 30-year Treasury bonds for a while. I will be surprised if this breaks through this line to go higher. It's a formidable, very long, very solid line here. A lot of psychology in this line. If I didn't already have over 50% still in long duration Treasury bonds, I would be buying here. The only reason I'm not is because I need to see more confirmation of weak economic data. JP Morgan's reports on Friday might pivot the whole market. It might shake things up, and we might get a bid off of that news in Treasury bonds. It's very possible, but you know, maybe that could help a bullish case. I might inch in a little bit more at that point depending on what comes out, but in order to go like 75% into this, I'm going to need to see unemployment rise. I'm going to need to see bankruptcies. I'm going to need to see some catalyst, some black swan event that or credit spreads like really unwinding, let's say, or widening quickly, things like of that nature. I'm going to need to see that if I'm going to be going purposefully much more than 50%, up to 75%. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.